Hi, I'm David Bodemer, the Editorial Director with National Real Estate Investor. I'm here at the Commercial Real Estate High Net Worth Investment Conference. I'm here with Michael Episcope from Origin Capital Partners. Thank you for joining us.
Thank you for having me.
Absolutely. So you were part of our opening session on the CEO discussion, where we had folks that have a variety of different ways of approaching real estate and having a discussion and about how, and also connecting with that kind of investor. So what were some of your thoughts about that discussion?
Well, I think looking at the other panelists there, it's really interesting to see all the different strategies within real estate. The hotel strategies, the opportunistic strategies, the operating strategies in multifamily, and it's such a diverse and interesting market out there, and you really get to kind of see what's going on in the environment and get a good feel for it with some industry experts up there who are really knowledgeable in the specific markets. And it's also nice to get in front of the high net worth investor groups, family offices, things like that, and kind of share our platform and ideas and share with them what's going on out there and some of the trials and tribulations we've had in the last several years.
And what is your firm's strategy within that spectrum?
So we're considered an opportunistic value-added strategy. That's the bucket we fall into, and we focus on underperforming properties in A locations where we can enhance value through either management changes, through re-tenanting, repositioning the asset, and we're focused on the higher quality locations in 12 markets, which are really from northwest all the way to southeast. We're looking at projects in Seattle, Denver, Phoenix, Minneapolis, Chicago, the 3 Texas markets, Dallas, Austin, Houston, and then on the southeast we're really focused in Atlanta, Miami, Orlando, and then North Carolina. We tend to stay out of the gateway markets. There's a lot of competition in those markets. It's not for any reason except we tend to go towards the secondary markets. There's a little bit more yield, a little bit less competition there. We like the growth stories in those markets as well. And our strategy is sort of the same regardless of where we go. We're trying to generate about a 200 basis point spread in yield to the market, cap rates through value-added repositioning.
And across property types?
Multifamily, industrial, and medical office really is what we kind of focus on. We're also in retail a little bit, but really asset agnostic at the end of the way. Our model is predicated more on deal flow. And seeing opportunities, and we don't have a mandate to be a certain amount in multifamily or industrial. So a lot of the risk we take and the returns we look is more controllable, idiosyncratic risk at the property level, and we try to limit the amount of macro exposure that we have, and really limit that by creating a margin of safety on our investments through the value-added process and enhancing revenue at the bottom line.
So you're looking for you're looking for opportunities. Really good sites in some of these markets that you're talking about that just aren't working right now, that you have an opportunity to kind of take them and take them to the next level. Is that fair?
It is, and underperforming, can be for a lot of reasons. It's usually a capital structure issue, it's a management issue, a partnership issue. There's usually people involved in some way, shape, or form, and the reason why it's underperforming. And so those are the kind of special situations we look for, and then we try to take those and nurse them back to health. And we're in a niche that's kind of $5 to $50 million, with our sweet spot being sort of $20 to $30 million, and we see that as a ripe environment, not only today but even in the future as we grow, because that's where a lot of the dislocation is. It's underneath the radar of the institutional guys, it's above the country club deals, things like that, and there's enormous transaction volume in that area as well. So we like that space today, and we don't see us moving out of that even into the future. As our funds get bigger, we'll just be doing more deals within the funds themselves in that space.
So when you're communicating now with this audience, or this kind of the high net worth investor, the family office, wealth management advisors, a lot of times it seems like for them it's like real estate is just like this big bucket asset class. So it's like, how do you communicate to them okay, there's lots of different opportunities, and this is this is what we do, and this is why it's a good fit for you. How do you kind of educate this audience?
There is a simplicity to real estate that I absolutely love. You can touch it, you can feel it, and we try to engage our investors in that way and speak to and kind of relay it to them. But I think that at the end of the day, it's also extremely complex.
Right.
And I think that a lot of people make the mistakes of going the do-it-alone strategy. I've owned a house, I've lived in a condo, therefore I understand apartment buildings. And you know, being in the industry for as long as I have, you really need an investment platform, and you need to see the universe of deals out there, and you need to have great operations, because at the end of the day, you can have the best property out there, but if you don't have top-tier operations and you're not underwriting it correctly and buying it correctly, or seeing the other available opportunities out there, you're missing a huge segment of the market. So it's really important that our investors, that we kind of see eye to eye, and that expectations are set on day one. And a lot of times we've had investors who go out there in the do-it-alone route only to come back to us and say, we get it now. So that's an education process.
And what kind of like holds, like how do the investors have with you?
So our funds are structured on a 5-year typical hold period with extensions if we need it. We need that flexibility, because you never know what the market is going to bring to you, and that's really important, I think, in any fund, to have that flexibility to continue the fund on. Typical deals are underwritten 3 to 5 years, although the last few years the tailwinds have allowed us to really accelerate a 5-year business plan into sort of 2.5 years, and we're taking risk off the table right now, as a matter of fact, because we've had such a tailwind behind us with the interest rates. So we've gotten lucky in many ways, but we combined great opportunistic value-added buys with a recovering economy, with compressing cap rates, and we're selling into this market today. And buying is a little more difficult. We've seen transaction volume decline. I think it's down 34% year over year from last year. I just read.
Interesting.
So it does impact kind of what we're doing in today's market.
Okay. All right. Well, thank you so much for spending some time with us and giving us some insight about your business and how it's all working.
Great. Thank you for having me.
Absolutely. And thank you for watching our coverage of the conference, and continue to watch our videos.